Welcome to Breaking News to Trading Moves. Today, we're looking at the market action after Beyond Meat settled its convertible debt exchange. What happened there was a really sudden, sharp move up in the stock price. Looked like a classic short squeeze scenario, really. And just to be clear, our goal here isn't about judging Beyond Meat's overall value, not at all. We want to look closely at the chain reaction, across the trading floor. Who were the winners, who were the losers, right after that happened. Okay, let's set the stage. The event itself. Beyond Meat, that's ticker BYND, they settled this convertible debt exchange. And it wasn't a small reaction. The price absolutely rocketed. We're talking triple digits. Hit something like, 117%? Around $1.36?
Yeah, it was a huge percentage move. Happened really fast, too. That kind of velocity is pretty rare. And just for context, one firm actually called it about a 3 sigma intraday event.
Okay, 3 sigma. For those of us not deep in stats, what does that actually mean?
It just means it was extreme. Statistically very rare compared to its usual day-to-day price swings. An outlier, basically. In a short term, anyway.
So why was it so violent? I mean, it feels like more than just settling some debt, more like an explosion.
Well, yeah, the groundwork was already laid, you could say. Before this settlement news hit, the short interest in BYND was already incredibly high. And the cost to borrow shares, the fees, they were also really elevated.
How high are we talking for short interest?
A short float was sitting above 50, maybe even 60%. So a huge chunk of the available shares were being shorted. So you got that massive short position just sitting there, right? Then you add a catalyst like this debt exchange settlement, and boom, that's the perfect setup for shorts having to scramble and cover their positions.
Okay, but I thought a lot of these shorts were hedged using convertible arbitrage strategies.
Many were, absolutely. That's a key point. They hold the convertible bond and short the stock against it. It's a common hedge fund strategy.
So if they're hedged, why the panic? Why the scramble?
Because the early settlement of that debt, that convertible bond, it pulls the rug out from under one side of their trade. Suddenly the bond part of their hedge is gone. It's retired early.
Ah, I see. So they're left exposed.
Exactly. They're left with a naked short position in BYND stock. And they have to cover it fast. They become forced buyers, pushing the price up, which forces more covering. You see the cycle.
Right, a feedback loop.
Yeah, and it makes borrowed really scarce, really expensive, and just sends volatility way up for everyone involved.
Okay, that makes sense. Purely mechanical, almost. So that forced buying created a huge trading volume. Let's follow the money then. Who benefited? I guess the most obvious group is that sort of meme stock short squeeze group.
Absolutely. Capital just chases momentum, especially extreme momentum like this. When a heavily shorted name like BYND takes off, money rotates in fast. You saw all the usual signs, sympathy bids and related names, maybe some gamma chasing in the options market, especially in retail traders.
And BYND itself obviously was the main name benefiting from the trading action purely because of the event. But did it spill over much?
Oh, yeah. It tends to flow into other heavily shorted stocks, the ones that traders watch for this kind of risk-on mood. A prime example that popped up was AMC Entertainment, ticker AMC.
Ah, the old favorite.
Right. It often acts as a kind of barometer for that whole space. It seemed to benefit from options activity picking up, traders feeling maybe a bit more willing to chase that kind of volatile name again.
So AMC moved higher just because BYND moved, not on its own news.
Pretty much seems that way, yeah. Just factor rotation, traders moving capital around based on the BYND action.
Okay, so beyond the specific stocks getting attention, all this chaos, the volume, the volatility, that must be good for the infrastructure, right? The trading platforms.
Definitely. That brings us to another set of winners, the retail trading venues and the brokers. When you get these spikes in share turnover, and particularly options volume, it feeds directly into their revenue. Higher transactions, better KPIs for them. Volatility is their friend, really.
So who specifically gets a lift from that kind of retail frenzy?
Well, Robinhood, ticker HOOD, is one. They typically see higher app engagement, more options trading when things get this active. Retail activity is their bread and butter.
Makes sense.
And don't forget the exchanges themselves. NASDAQ, NDAQ, for instance, they benefit from just higher trading volumes overall, plus things like market data fees. The whole ecosystem gets busier.
Right, more tolls being collected. And what about the big Wall Street players? The ones handling the institutional flow, the lending of shares, the complex hedging?
Yeah, the securities lending desks and the big flow franchises, they do well here too. Think about those borrow fees we mentioned. They were hitting extreme levels on BYND around mid-October, according to Fintel data. That's direct revenue for the lenders.
So the prime brokers make money just from lending the shares out.
That and facilitating all the trading, client activity, delta hedging from options market makers, the covering itself. It all generates prime brokerage fees and trading revenue.
So firms like Goldman Sachs, GS.
Exactly. GS is set up to monetize that kind of client flow. The financing needs that top up. Same for Morgan Stanley, MS. They have huge scale in prime brokerage equity derivatives. They're positioned to capture revenue from the execution, the borrowing, the hedging, all of it, when a big event like this happens.
Okay. Seems clear how the trading and financing side benefits. But you can't have winners without, well, maybe not losers, but pressure points. Who felt some heat from this? Let's start with maybe the traditional meat companies.
Right, the conventional meat packers. This is where it gets a bit more about narrative than direct finance. Even though the trigger was just this debt swap for BYND, the headlines immediately bring back that whole alt protein versus traditional meat conversation.
So even if nothing changed fundamentally for, say, Tyson or Hormel, the story shifted.
Kind of, yeah. That renewed chatter can put pressure on the sentiment for incumbents like Tyson Foods, TSN, or Hormel Foods, HRL. Portfolio managers might see the BYND volatility, see the alt protein story flare up again, and decide to trim their exposure to traditional protein names, just managing their factor risk, driven by the market noise around BYND.
Right, a sentiment and positioning adjustment. Okay, what about other highly shorted stocks, small caps that didn't have a catalyst like BYND?
Yeah, that's another group feeling pressure. Risk capital is like water. It flows to where the action is loudest. So if you're a heavily shorted company, but you don't have a fresh reason for people to buy your stock right now, you can see trading volume dry up a bit. An air pocket, sometimes called.
Because the traders are chasing BYND instead.
Basically, yeah. They redeploy capital out of maybe quieter shorts and into the name that's actually squeezing. So you might see that rotation risk impact names like Nikola, NKLA, or Clover Health, CLOV. If you're shorted but not moving, the hot money goes elsewhere, and your stock might drift lower just from lack of attention.
Okay, that makes sense. One last category then, the places that actually sell the products. The big grocery stores, the retailers. How does BYND's debt deal affect them?
This one's more about the future competitive landscape, maybe some margin pressure down the line. Think about it. Before this refinancing, maybe BYND was a bit tight on cash, couldn't spend as much on promotions or marketing to gain shelf space.
And now, with potentially a stronger balance sheet.
Now, the thinking is they might get more aggressive, use promotions, maybe some markdowns to try and win back or expand their presence in stores.
So that could squeeze the margins for the retailers?
Potentially, yeah, in the short term. If BYND pushes hard on promotions, it can affect the margin mix for the big grocers like Kroger, KR, or retailers like Target, TGT, as they adjust their own pricing and deal with those resets. It adds a bit more competitive pressure.
Okay, that covers the landscape pretty well. So for listeners who might be watching similar situations, maybe another company with high short interest facing a financial event, what kind of market behavior should they anticipate?
Well, volatility is almost a given. You should probably expect what traders often call gap and grind action.
Gap and grind.
Yeah, sharp opening moves maybe, followed by choppy trading, rapid reversals intraday. The moves can be very mechanical, driven by flows, not always fundamentals, so expect some whiplash.
And what metrics are key to track in that kind of environment?
Definitely keep an eye on borrow rates and how easy it is to get shares to short. We mentioned Fintel showing those fee spikes for BYND, tracking those rates intraday. Tells you how much pressure shorts are under.
Okay, borrow costs. What else?
Volume is crucial. Volume relative to the average. Volume relative to the float. And the days to cover metric. With BYND short float still reportedly above 60% even after the initial pop, that suggests there's still, let's say, fuel in the tank for more volatility if borrow stays tight or another catalyst comes along.
And if someone's thinking about using options to trade this kind of situation,
just be aware that implied volatility, the IV, is likely going to be really high. Everyone rushes to buy calls, pushing up the price of options. So jumping into naked calls when IV is already inflated can be pretty risky. You pay a huge premium.
So what's the alternative?
The analysis often suggests looking at defined risk strategies. Things like debit spreads, perhaps. They limit your upfront cost, your risk, while still letting you participate if the stock does move your way. Just caps the risk compared to buying calls outright in a crowded trade.
Okay, good points to keep in mind. Well, that wraps up our look at the Beyond Meat situation, the trigger, the squeeze, and how the effects spread out across different parts of the market.
And just a reminder for everyone listening, this is not financial advice. Nothing here is a recommendation to buy or sell any security. This is purely the opinion of the author.
Right. And as a final thought for you, the listener, consider how this one specific event, just a company sorting out its debt, immediately sends waves through seemingly unrelated areas from meat companies to big banks to grocery stores. It really shows you how interconnected capital flows are, especially when volatility picks up like this, something to think about as you watch the markets.